Hello and welcome. Today we're going to be talking about a stock in the chemical space, but it's rapidly going up the value chain on the value curve within the chemical pack. It used to manufacture caustic, still does, caustic soda, but and we've seen a very sizable correction in the stock price as well, around 37% lower on a 12-month basis on the stock price. Let's quickly take a bit of a step back, try and understand Epigral better. It was incorporated in 2007 as Meghmani Fine Chem, was listed, of course, and in 2023 it was renamed to Epigral. Current market cap is around 4,900 crore odd. It's an integrated manufacturer of chlor-alkali and specialty chemicals. That's the space it's in. Let's first talk about the chlor-alkali products that they have. One is caustic, and caustic soda it's a strong cleaning chemical essentially, and it is the end use in terms of industries, alumina, textiles, chemicals, soaps and the like. And then there's caustic potash as well. The only composition difference there is the fact that there is potash. The role is the same, and caustic potash is typically used in soaps, agrochem, pharmaceuticals and the like as well. So it's only a composition difference between the two, the end use case being the same. Chlorine is essentially somewhat of a byproduct for the company, and now chlorine is used, the gas is obtained as part of the caustic soda manufacturing process, and it's used for higher value added products, and that's what they're essentially doing, putting that to use. Hydrogen is the other byproduct, and again it's been used for it's used as a clean fuel, of course. Raw material for other products is also where it is used. Then there's derivatives and specialty products and chemicals, and that's where Epigral is making a big shift. In fact, currently 50% of the top line is derivatives. This will go up to 70% by FY28, and that could be a very big shift in the next couple of years. So not only will there be a growth on the top line, very likely I'd be interested to know what this does to margins as a result of this big shift. But let's talk about these 3 or 4 products in the derivatives and specialty chemical space. Chloromethanes are nothing but solvents. They're used as solvents for medicines, refrigerants, as well as special plastics. Then there's hydrogen peroxide also, which is what they manufacture. It's an oxidizing agent for paper, textiles, effluents. It's used for bleaching, whitening, and water treatment. Then there's CPVC resins. Now, this is more commoditized as a product. But basically it's a heat-resistant polymer for pipes and fittings, and the end use case, of course, is hot water pipes, industrial pipes, fire sprinklers and the like. Then there's CPVC compounds, which is ready-to-use compounds for pipe manufacturers, again slightly up the value curve. And then there's ECH, which is epichlorohydrin, which is an epoxy resin from bio-based glycerine, which is manufactured from bio-based glycerine. It's used for the production of epoxy resins. Now, the use case for this is very interesting. You've got wind turbines, aircrafts, electronics, paints, and adhesives. That's where ECH or epichlorohydrin is used. It's called ECH, and we will term it that for the rest of this chat. And then there are other intermediaries which are used in the pharma and agro space for crop protection chemicals, specialty chemicals, pigments and the like, which fall in this last basket. Let me now talk about the sum and substance of the story, right? Epigral was a salt manufacturer, moved towards, with electricity, added caustic soda plus chlorine and hydrogen, which got manufactured thereafter. Thereafter moved to chloromethanes, hydrogen peroxide, ECH, CPVC and the like. And of course, epoxy resins is now the final product which they are looking for. And they've basically gone up the value curve in terms of the journey. They continue to manufacture a large chunk of caustic, and caustic is in the internal use of caustic is still just 50%. So there is still a large runway in terms of utilization towards better or value added products, even for the caustic that they manufacture internally, caustic soda. Now let's talk about the other things that they do. They also have integrated captive power which they produce internally. And there's a coal-based power plant also which they have. There's a wind solar hybrid power as well, which they are going to bring on stream or continue to add on stream. There's obviously an R&D center as well, which they have in Ahmedabad, that develops new intermediaries and processes on a recurring basis. And the upcoming epoxy resins and formulations are also part of the R&D that they are doing. And there's a multi-purpose plant as well that they are putting up in Dahej, which is their Gujarat manufacturing facility. Now let's talk about that manufacturing facility a little bit. It gives you what kind of scale that Epigral wants to operate at. So this is currently the capacity for each of the products that Epigral does. In terms of yet to come on stream, epoxy resins is around 125,000 TPA, which is completely fresh capacity expected to come. Then there's CPVC resin expansion, which they are undertaking, and there's ECH expansion also. This is the values post expansion. This is, of course, the fresh value coming in terms of capacity. So there's a large capacity addition. This should typically take around 800 crore more of capex, FY27 plus FY28. 600 crore for the fresh capacity is added alone, 300 crore each for each of the years. And what this will do is, this will give them an additional maybe 1500 crore of revenue based on the con call that they have spoken about. And of course, on top of that, you'll also have additional capacity and efficiency which will get built up, which should take the top line from the current 2,500 crore to 5,000 crore. That's really the guidance in the next 5 years. So not only are they going up the curve with regard to value-added products, they're also adding a large amount of capacity, which should drive the top line higher. Let's talk about customers that they have. Kukdo Chemicals, Divi's, Sumitomo, Astral, ITC, Prince Pipes, Atul, Aditya Birla Group, IPCA, just some of the familiar names in terms of the customers that they have. In terms of revenue mix, we've spoken about this a little bit. Of course, Vedanta as well on that customer list, as you can see. Revenue mix currently, derivatives is 52%, chlor-alkali is around 48%. That will change. The derivatives will go higher to 70% and chlor-alkali will just be 30% by as early as FY28. The revenue mix is pretty much entirely India. These are import substitutes, especially on the epoxy, ECH side of things, and therefore Epigral will actually make India less import dependent on some of these products. Let's talk about the financials, and what we've seen is the top line growth has not been as strong, but we've seen an 11% growth of a slightly elevated base of FY22. We've seen 11% growth on a 3-year CAGR based on FY23's numbers, of course, but FY22 was slightly elevated. And thereafter, we've seen 11% 3-year CAGR. The EBITDA has grown at 7% CAGR, and the PAT has grown at 11% CAGR. These things may well change. When you're looking at the Q1 numbers, there's been a 16% growth on top line YOY, 10% growth on EBITDA. Profit is lower due to largely saddled by debt and depreciation. But the other more important piece is the fact that the first 3 quarters of FY26 were slightly more difficult from a realization standpoint. That changed in Q4. So those numbers are a little bit softer when you're looking at the base year. When you're looking at margin trajectory, it's largely been between the 22 to 27% kind of margin print. Currently sitting at around 25 for Q1 FY26. Realizations have been choppy but have been strong in the sense that the choppiness has been around 10 to 15% on realizations, but it's been far stronger than last year. That's the way to look at this. And therefore, that is reflective on the margin versus FY26 margins of 22% that you can see. When you're looking at the balance sheet, you're seeing around 2,220 crore of equity sitting there. So this trades at roughly 2 times book, roughly, slightly sub 2 times book, or rather slightly higher than 2 times book, I beg your pardon. You're looking at debt or borrowing of around 560 crore, large capex coming in, and therefore we'll quiz the management on what happens to that debt number. The cash is around 5 crore odd. Where again, we look at the balance sheet and we feel okay because we are looking at around 9 times market cap to borrowing, which kind of gives you some comfort, and 1:4 on the debt to equity as well, roughly. That's how it stacks up. When you're looking at the cash flow, and cash flow conversion has been good, it's been fairly reasonable, 75% plus. So therefore, no concerns from that perspective either. Return ratios. Now, this is what kind of stands out. In a company doing high capex, ROC has become important. They've done consistently 15 plus. In good years, they've done 20, 25, even 30 plus in very good years of FY23, which you can see on your screen. The guidance also is that the goal is to hit that 20% ROC on a consistent basis. Really, that's on the fresh capital also that they are deploying for the business. Let's look at shareholding. 69% held by the promoters, so no concerns there at all. 1% FI ownership, it's trimmed down from 3. DIs have held on to their 5 to 6% stake, and the public hold the balance, which is 25%. Let's look at what the analysts are saying. And frankly, just 3 analysts covering the stock because it's relatively smaller. 2 buy calls, 1 sell, no holds, 28% upside is what they see. We are cautious only from a perspective that only 3 analysts track the stock and there's 1 sell within those 3. When you're looking at valuations, currently it trades at 14 times 1-year forward earnings. The 5-year average is also in around the same number. 7 to 28 times is the range in which the stock has traded in. And therefore, again, you're largely okay with regard to where valuations are concerned. Now, let me bring on board Mr. Maulik Patel. He is Chairman, Managing Director of Epigral, joining us this afternoon to give us a perspective of how should one look at the business. Maulik, very good having you here. Let me first start off by trying to understand from you how are realizations trending. And let me try to go product-wise as well. Let me first get caustic soda realizations out of the way. Q4 was strong for you. Has that continued in Q1? Is it sustainable onwards?
So caustic soda is mainly, it is based on the power intensive and looking at the current scenario because of the war, the oil and the energy cost is going up. Caustic soda price is also going up. But if you see the caustic soda consumption in terms of India, alumina production is going up, aluminum production is going up in India, and everybody is expanding. So looking at the long term, the caustic growth is normally it is around GDP growth of the country. So it is going to continue in terms of the growth of the caustic soda. So we find it in the long term, I think it is going to continue, and the price in coming year also we are expecting in the same range as Q1.
Okay, and therefore that 35, 36,000 which we saw in terms of pricing in Q1, do you believe that that's an anomaly, and maybe 32 is something which is closer to the kind of pricing that we'll see on the caustic side of things?
Yeah, so 30,000 to 32,000 kind of level of ECU, which we say in the caustic industry, that is realistic. As I mentioned, Q1 is abnormal in terms of the energy cost point of view because of the war situation. And in current quarter also, the situation is similar. So we are expecting in the similar range, but in the long run, I think you can expect 30 to 32,000 kind of ECU level, and when everything is normal level, yeah.
Okay, and what about CPVC? That also the pricing there also has been choppy. There's those minimum import price restrictions which have come in. How is pricing playing out over there, and how is that playing out on your margins? Could you give us some perspective?
So CPVC is the major raw material is PVC, which is also related to the oil industries, which is ethylene based and which is mainly supplied globally. In Asia, mainly it is supplied from the Middle East also. So that is a concern in the current time. So price is fluctuating very high in the Q1 and in Q2 also. But that's why the people are very cautious in terms of the buying of the raw material. So demand in terms of Q2, we are expecting little less. And even though in the monsoon season, CPVC is mainly used for the pipe application, so it is always demand is lower compared to Q3 and Q4. So normally the majority of the business happens in the Q3 and Q4 in our country. So we are expecting in terms of as a year as a whole, we are not expecting any demand decrease in this financial year.
Okay, but pricing is holding up, is what you're saying. What happens to margins, pricing, therefore, given raw material prices as well? Give us a sense of that.
So pricing, in terms of pricing, Q1 and Q2, I think it is almost is going to be in the similar range level. We are expecting because the situation in the war is same and oil prices and the logistic is a similar issue right now is going on. Still, it is not completely gone. So we are expecting in the similar range will continue in quarter 2 also.
Okay, and margins?
So margins we are expecting, as a company, as a overall, we are expecting margins will remain between 20 to 25% EBITDA level, and that we are giving as a guidance as a company as a whole. So definitely, the product wise, it's keep changing, minor here and there, depends on the raw material situation, depend on the demand situation. Because as a company as a whole, we are catering in the so many end use industries. So every quarter depends on the demand of that particular quarter. It's keep changing. Some industries, some end users like pipe industries and infrastructure related chemicals like epichlor and the epoxy resin. That is normally second half of the year is always on the peak side compared to the first half of the year. So as a year as a
Maulik, I'll
whole,
come.
we are expecting 20 to 25% level kind of EBITDA margin we are expecting from the as a in overall product.
Got it. That's a wide range, by the way, on margins. But if you can give me a perspective, when you're looking at CPVC in particular and the way in which raw material prices are shaping up, are you able to pass that through to customers, and therefore largely will margins hold versus what you are penciling in? And also, are there any one-offs in the numbers, just given the fact that maybe you were sitting on some inventory, whether raw material or finished product, versus the realizations that you're now getting for this, probably the same product?
So yes, you are absolutely right, because we have a production level. It is such a huge quantity. We are the largest of the CPVC manufacturing in India right now, and even in the world also. Once our expansion will be completed, so we need to keep as a minimum inventory as a raw material in always. So definitely, when the price is going up, we are seeing there is an advantage in terms of the raw material what we have, and when the price is going down, definitely we have to face other way around also. But as a year as a whole, as I mentioned, we are going to get similar kind of margin what we are expecting, because as I mentioned, first half of the year it is always down compared to the second half of the year in terms of the demand situation in the infrastructure related chemical industries.
And yet you've done 25% margins, Maulik. So that should trend
Yes.
only better, right, in H2. I mean, you're guiding for 20 to 25, but if H2 is going to be stronger.
Yes, in terms of demand, H2 is always going to be stronger. Margin we are expecting in a similar range year as a whole.
And what about competition in CPVC? That's the other piece which worries the market, right? You've got large players coming into the space. Will there be larger disruption? And at the end of the day, there's some bit of commoditization of CPVC also. Is that a risk you run, given the kind of capacity you have?
Yeah, so India is a growing country, in terms of, we started as a first manufacturing of CPVC in India and going for expansion continuously. 3 times we have expanded, and I think now once the last expansion will be over by end of September, end of second quarter, we are going to be the largest manufacturer of CPVC resin in the world. And because of this, and we are forecasting India as a growth engine going forward, because the demand which we are having in the country in terms of the chemicals, I don't think so anywhere else similar kind of growth level is possible in the current situation of the world. And we are forecasting next 3 to 5 years requirement in India, and we are expanding that. Definitely, if some player is coming, there is overlapping in that particular year, but based on our past experience, India's growth story is going to continue, and the demand will pick up every year based on the particular chemical. So we are not expecting in a long way. Definitely, India will consume, and I think we are in a better situation because we are a first mover in this industry. So we don't
Give us.
see in the short term we might feel a little over capacity, but in the long run we are not expecting that kind of situation. Majority of the chemicals, I think it is a similar range. What we expect in our past also, in the caustic soda also, when we expanded every time, we feel there is a little over capacity. But eventually in coming 2 3 years time, once we reach to the optimization level, we find now another expansion we need to do it based on the India's growth story and the consumption story.
I want to talk a little bit about the expansion that you're doing, right? Very large one. And I want to club it with ECH and epoxy. What's the kind of traction that is there in some of these products? How much is India dependent from an import perspective in these products? And therefore, I'm trying to understand whether this very large capacity that you put up, is there enough demand for it from an India perspective? Are we competitive enough from an India perspective, India pricing perspective? And last off, I want to also understand whether approval cycles have been cleared from your customers' end as well with regard to these two products.
Yeah. So that's interesting questions you have asked. I think majority of the questions regarding the product you have covered in this. So let me start with, we are into the epichlorohydrin. That is also, it is similar kind of CPVC where we are the first mover advantage, and we are manufacturing from the glycerin as a raw material, which is we are not dependent on the any kind of petrochemical or oil source in this. It is coming from, it's a renewable chemical, you can say that, in terms of epichlorohydrin, the way we are manufacturing. Epichlorohydrin, after 50,000 tons, first we set up a plant, and once we reached the optimization, we decided to go for an expansion of epichlorohydrin because we feel that India's epoxy resin demand is going to continue in a double-digit growth, and that's why all multinationals are also targeting India as a destination to set up a plant in India also. So we thought, we are expanding epichlorohydrin, and the same time we also expand in a epoxy resin also, because the consumption in India, it is growing in all segments. Epoxy resin majorly it consumes in the automobile, windmill, renewable sector, and the construction sector. So all three sectors growth in India is in high double-digit growth. So I believe, and if you see the history of the developing countries, in the China also, 2010 to 2020, the China has expanded epoxy resin capacity exponentially because of their internal demand of the country. And we cannot compare with the same kind of growth, but definitely India's also required epoxy resin consumption in the same way it is growing, because the demand side we are very strong.
And Maulik, therefore, this 800 crore capex that you are planning to put up, 400 crore in each of the years, FY27, FY28, how are you planning to fund that? Because it's a large kind of funding requirement.
Yeah, so currently we are, our debt to EBITDA level is almost close to 0.9, and every expansion, we are able to finish our CPVC and epichlorohydrin expansion probably in end of September. So whenever we are announcing any major capex, end of that capex, we announce another growth story as per the country, as per the company. We wanted to grow at 15 to 20% every year. So that's why we have announced this is as a forward integration to epichlorohydrin is a epoxy resin and the formulations and the multi-purpose plant. So this, both the projects we are going to fund internal accruals and the debt also, because the debt which we have taken in the past, it is around close to 0.9 debt to EBITDA, and it is also repay every year. So by the time we are commissioning this project, our debt level will not be increased that much, and our top line will be increased. So debt to EBITDA level, again, we are going to be back to a normal level. So as a company, we have kept as a target that we do not want to increase our debt to EBITDA level more than 1.5. That
more
is
than
the
1.5. So there's a lot of headroom there.
Yeah.
There's a lot of headroom there. Okay, and are the margins in epoxy and ECH better than your current margin guidance of 20 to 25%? Will it add maybe a couple of 100 basis points to margins in terms of your guidance as well?
So in terms of margin, epoxy resin is, definitely compared to our all past products, compared to the investment to revenue ratio, if you see, in epoxy resin has a very high revenue compared to the investment what we are doing. So that ratio is always very high compared to other industries what we are invested so far. So we are considering mainly the ROC, not the margin, but when we decide any project. So ROC, we are targeting normally when we decide the project, it is close to 20%. We would like to target the ROC. But margin wise, definitely it has a lower margin in terms of EBITDA level, but it has a high turnover ratio compared to the other products. So we are expecting absolute value, and the ROC point of view, this is a good product going forward. That's why we are investing in epoxy resin. And 50% of the raw material as a ECH and the caustic soda, which is a basic raw material for epoxy resin, which will come from the internally. And another reason, we are also expanding a multi-purpose plant where also value addition of our chlorotoluene and chlorotoluene product where we are focusing on the agrochemical, pharmaceutical, and the water treatment chemicals. So we are
And
expecting 20 to 25% margin will remain same kind of level. It will not have a major impact, but absolute terms, our profitability will increase.
And will this ensure that that till 5,000 crore, no additional capex will be required, or will more capex be required for that 5,000 crore revenue that you've guided for next 4 to 5 years?
So, if you compare our so far, we have invested, close to 3,200 crore level in investment, which we have done already. Where the CPVC expansion and ECH, the revenue still need to generate from that kind of capex. And after this 600 crore capex, which we have recently announced, epoxy resin and the multi-purpose plant of chlorotoluene derivatives, both the capex, everything is once it is reached. After that capex, everything will reach on the optimization level. We can generate a revenue of close to 5,000 crore kind of asset block will be ready.
Okay. Thank you so much, Maulik, for coming in and speaking to us. Completely timed out on this edition of All About Your Company. Thank you so much, viewers, for tuning in.